All right, let's go ahead. Let's bring on Tom Hayes here, the chairman and managing member of Great Hill Capital. Welcome back. Well, it's kind of a newer show, but rebranded. We'll say that. Welcome back, Tom.
Good to be with you, Mitch, as always. Thanks for having me on.
Definitely happy to go ahead and get into it. First thing I want to talk to you about something. I'll say it's the vital question of the week, even though I'm sure I'm going to get some complaints about this. So, who do you got for the Stanley Cup final?
Oh, unquestionably the Bolts, man. I mean, Tampa Bay, without question. Avalanche is going down. I know you're kind of, oh, you like the Bolts. All right, that's a good thing.
This is the first time that this doesn't happen often, but I usually have two teams that I like. I'm a big Tampa Bay fan, so anything really Tampa Bay, the Rays, the Lightning, I love it. I've been there plenty of times, but I've also, going through the struggles because I was kind of rooting for Colorado because I lived there for a little bit. So,
Yeah.
hey, both teams. We'll see what happens. But I'm going to go with the Bolts. Let's do it.
Yeah, it was very, very simple. I grew up in New Jersey as a Devils fan, so just watching the Rangers miss the ball on that one was a very, very positive experience, I have to say.
All right, perfect. Now, before we get too much there, we'll get it back into the stock market. First thing I want to know is kind of your reaction to the CPI data, the recent data, and where do you think the market is today?
Well, the bad news is it was a train wreck. It was about as bad as you could possibly get. If you thought it was going to be bad, it was even worse. Across the board, you could find no green shoots. So that's the downside. The upside is I'm looking to the PPI report tomorrow, and I don't hear a lot of people talking about it, but CPI often lags PPI, producer price index, come first, and then over a period of months, it finally gets to the consumer. And the reason that I'm somewhat cautiously optimistic about the PPI number tomorrow and the timing of it is if you look recently, there were three key input costs that have come down pretty dramatically that no one's talking about. First off is PC DRAM prices. Those are down 14% year on year. They're at half the price of July of 2018, and that's a bellwether for semiconductors, which is in everything, including automobiles, which we're going to talk about that in detail in a second. The second thing that's come down is 24% since March, believe it or not, are North American fertilizer prices. No one's talking about that. That will trickle through to the consumer, albeit on a lagged basis. And the final thing is, if you look at the Drewry shipping index, it's down 26% now since September of 2020. So some of that supply chain stuff is easing. Obviously, the number one thing that's been causing all the pain is energy, which is the critical input cost. And the developed world has made a conscious or unconscious decision that they were going to subsidize the defense of Ukraine at the gas pump. And the question is how long will they have that resolve to continue to finance that defense and deal with these persistently high energy prices, which is taking a lot of disposable income out of people's pockets. And on the one hand, ideologically, everyone wants to continue to do that. But on the other hand, the pressure has been on now for a number of months. And Zelensky said as much last week that perhaps Western powers are trying to encourage him to take agreements that he was not really excited about because they're growing weary of the war. So, you can't handicap when that stuff is going to happen. The good news is maybe we'll finally see some relief with the PPI print tomorrow, which will give the Fed cover on Wednesday at the Fed meeting to say, look, the CPI was a train wreck, but the numbers we're looking at are showing us to have a little patience here. Just look at the PPI yesterday. That'll trickle through. That would be the rainbow scenario. After Friday, you can't count on the rainbow, but be open-minded that it might happen. And particularly with kind of that leg sweep this morning, taking out all the stops below the recent low on the S&P, kind of looks textbook to me, as a possibility to see a rally that no one is positioned for. Not, super confident on that, but the setup looks awfully familiar, and I've seen this a number of times in my career.
Yeah, I think you're right. PPI definitely focus, and one of the things that we're going to definitely watch, and you're giving us right now, kind of that one of those signs. But maybe you see something else. Is there any other signs that you're seeing that this let up could come in from this recent down move? I mean, we are seeing a pretty bad market breadth out there right now. Is there any other signs that you're seeing other than PPI that
Yeah,
show a let
look, I
up?
mean, everything's flushed. We've almost run out of sellers, Mitch, but that's been that way for a number of weeks on and off. But at some point, you do hit that final seller. I mean, you got to your point. You mentioned consumer sentiment. It's the lowest. It's lower than the Great Financial Crisis, 2008, 2009. That's kind of unwarranted when you consider, GDP growth. You consider the population, you got 31 million millennials starting housing formation. So to be as pessimistic as 2009, when you had a real credit crisis and we were right at the edge of the cliff, seems a little overdone. The fear and greed index is now at levels you want, historically you want to be a buyer. It's down to 19 today. That's a compilation of a number of indicators. You saw the AAII sentiment on Thursday, 21% bullish. That's below the pandemic lows. 47% bearish. I mean, we had no vaccine, no clue what was going to happen. And people are more bearish today because they're feeling it at the pump. They're feeling it everywhere else. But as it relates to energy, one, you could maybe get a resolution with the geopolitical, but you can't count on that. The one thing that we can count on is production is coming up in the United States. So at the pandemic lows, you had 244 rigs in service. Today, you've got over 727 rigs. And that's down. The pre-pandemic level was 792 right before the pandemic. So you went from 792 to 244. Now we're back up to 727. So that energy's coming back online. Biden's going over to Saudi Arabia to talk to them about producing some more oil. That could potentially be helpful. We'll see. And then you look at many of the other commodities have softened in recent weeks and months, like wheat, like live cattle, like cocoa, lumber, copper, soybean meal, gold, even palladium. They're lower. So, but these things work on a lagged effect until the consumer starts to feel it. And maybe the Fed will have something to say about that. But if they don't, they've got to regain control of the narrative. So if they don't have any good news on the inflation numbers, if they say, yeah, Friday was terrible, we didn't expect that, well, then they've got to say, we're going to pull forward July's rate hike to June. We're going 75 or 100, and then we'll see what happens. Maybe we'll do nothing in July, but we got to get ahead of this if they've got nothing good to say. If they come off a good PPI number, they're going to say, look, this is what we were seeing. This is why we've been a little bit slower. This is going to take a little while to trickle into the consumer, but we're pretty optimistic. Then, that could be fodder for a nice rally. But one of those two things need to happen. Either one, they need to jump on it, or two, they need to say, here's why we didn't jump on it. Look what happened with the PPI coming to a theater near you. Prices will come down. But that's a tall order. And I couldn't even place a probability on the PPI tomorrow after what happened on Friday with the CPI, because all bets are off the table. But I'm open-minded to the possibility, based on DRAM, fertilizer, and shipping, that it could be a nice number.
Yeah, even Vegas didn't want to get involved in those odds, but we won't talk about that, Tom. Now, one of the things that we've been pointing is, what are the signs of potentially a turnaround? But also, let's not get too far away from what we're seeing too. And there could be potential for some of these sectors of industry to continue on the downside action. So is there anywhere you're seeing just weakness coming in, or maybe like today we're seeing energy turn around a little bit here? What do you think, Tom?
Yeah, look, I've been, if you go back, as you know, I run the website hedgefundtips.com, and I post a weekly commentary, and I post a weekly video cast that has a lot of institutional followers. We were pounding the table to buy energy in fall of 2020 when no one wanted it. And that's our nature. We buy things when they're out of favor. We sell them when everyone wants them. We've been sellers of energy for the last couple of months plus, off of those 2020 lows. So everyone wanted energy this year. We're selling into that strength, sold to you And now I think it could come in. I mean, people are pricing in this perpetual rise of energy in perpetuity. And one of two things is going to happen. Either the production is going to come back quickly enough, either from some breakthrough in Russia, some breakthrough in Saudi Arabia with pumping more, our own production. One of those things is going to happen, or the Fed is going to destroy demand by having to hike to rein it in. And in that case, energy is coming down anyway in the short term. I just think too many people have gotten excited of late. The same people that wanted nothing to do with it in 2020, now that it's up, depending on the name, 200, 300, 400%, now they can't get enough of it. And usually when that happens, the market opens the trap door for the Johnny-come-latelys. So we'd be more inclined to be lightening up on energy and looking at some of the things that are now out of favor.
Yeah, definitely. Now, one of the ways that I wanted to wrap up is I know you always try to help out also the retail trader on out there. So definitely, guys, check out hedgefundtips.com. And one of the things that you do on there, and I really love this, I check it out all the time because I'm a technical fan. So on Friday, you released the indicator of the day video. And so if you guys want to check that out, it's actually in the description below if you want to check this out. And so you put out the McClellan Summation Index. And I think this is an important one to go, especially on a day like today, where, where we're seeing such change in market breadth and it's extreme. So talk to us a little bit about the McClellan Summation Index and how it's used.
Yeah, look, I mean, all of these barometers, as you know, we put out one a day, and I've got a guy named Carter working for me that's now putting out some of the new videos. I don't know if you've noticed that. But what you're finding across the board, and there are like literally 400 or 500 of these different indicators, and they all kind of point to the same, whether it's the McClellan Summation, some of the sentiment indicators that I shared with you earlier in this call. All that's telling you is, are you at an extreme? And I don't actually look to what is the definition and what is the calculation. I just overlay it with the S&P 500, because all I want to know is, do odds favor being a buyer or do odds favor being a seller? And nothing works perfect. But when you look at 10, 15, 20 of these things, your favorites all together, and if they're all pointing to everyone's flushed out, that's usually time to start to nibble and increase your position sizing. And when they're all extreme on the top and everyone is buying, everyone's excited about the market, that's usually when we're lightening up and raising some cash. So whether it's the McClellan Summation or any one of the other indicators, we put out one per day, 7 days a week. You guys can check it out with a 60-minute video. And right now, the vast majority of our indicators are pointing to, selling is flushed out here. So what could be the catalyst? I honestly couldn't think about it until I looked at the economic calendar this week and I saw the PPI tomorrow and how high the estimates are. And then I looked at some of my data that I look at, whether it's DRAM prices, fertilizer, shipping, et cetera. And I said, okay, that could be it, but we won't know until tomorrow. And, the S&P 500 is trading at 15 times next year's earnings right now. That's down from 18.6 times average for the last 5 years, which included the last tightening cycle, by the way, Mitch. So, at this level, if you have a time horizon more than a year or 2 years, I think a lot of institutions have to be starting to step in at these levels. They've kind of sold out of everything. We saw in the Bank of America survey a couple weeks ago, their cash levels were the highest since May of 2020, which was near the pandemic, before the vaccine. So I got to assume anyone looking at what I'm looking at, even if estimates come down materially, the multiple's starting to get really attractive. And on a sector by sector basis, you can find things to do.
All right, guys. So definitely check out hedgefundtips.com, and we'll have you back on. Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Appreciate you like always, Tom.
Thanks, Mitch. I appreciate being on with you. Have a great one.
Have a good one.